Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding OTC Derivatives, a key guide for financial markets in 2024. Have you ever wondered how big players in finance manage risks without traditional exchanges? That's where over-the-counter, OTC, derivatives come into play. These financial contracts allow institutions to customize terms, giving them flexibility not found in standard market options. The finance world relies heavily on OTC trading for hedging and speculation. In this video, you'll learn why OTC derivatives are essential for financial markets and how they shape trading strategies globally. Let's explore this key piece of the financial puzzle and see what it means for 2024 and beyond. What are over-the-counter, OTC, derivatives? OTC derivatives are financial contracts formed between two parties without the traditional exchange framework. They offer the freedom for customization, allowing the parties involved to tailor agreements to their specific needs, a contrast to the often rigid terms of exchange-traded derivatives. But what sets these financial instruments apart? Let's break it down. Key differences from exchange-traded derivatives. Customization. Unlike exchange-traded derivatives, OTC derivatives are not standardized. This means parties can negotiate terms like expiration dates, contract size, and underlying assets. It's like tailoring a suit. You get exactly what fits your needs. Trading environment. OTC derivatives are traded directly between parties, usually banks or financial institutions. This contrasts with exchange-traded derivatives, which are handled through centralized exchanges like the NYSE or CME. Regulation and transparency. Exchange-traded derivatives come with significant regulatory oversight and transparency. OTC derivatives, however, often involve less visible transactions, posing greater counterparty risk. You're relying on the other party to honor the deal, much like a handshake agreement. Market size and reach. The OTC market is massive and caters to a global network of participants. It allows trading in instruments that might not be listed on traditional exchanges, giving access to a wider array of options. Why they matter. OTC derivatives matter because they provide flexibility for hedging and investment strategies. By not being bound by exchange rules, participants can create unique instruments to manage risk or speculate on market movements effectively. Recap with a personal insight. Imagine being a chef. With OTC derivatives, it's akin to having a pantry full of unique ingredients, allowing you to cook meals that cater specifically to a diner's taste, whereas exchange-traded derivatives are like ready-made meals. Both have their place, but one allows for personalization where the other doesn't. Which option would you choose to suit your financial palate? In the ever-evolving finance space, understanding these nuances is crucial for making informed decisions in 2024 and beyond. Keep your mind open to the myriad possibilities that OTC derivatives offer, and you'll be better prepared to navigate the complex world of finance. Types of OTC derivatives. OTC derivatives offer a wide range of financial instruments, each with its unique benefits and uses. These derivatives are not bound by the standardized contracts of exchanges, offering freedom in terms of customization. Let's dive into some main types of OTC derivatives and see how they work. Forward contracts. Forward contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. They are highly customizable, allowing parties to tailor them according to specific needs regarding terms and conditions. Structure. These contracts are bilateral, involving negotiations directly between the buyer and seller. Parties settle the contract at maturity, unlike futures, which require periodic settlements. Common uses. Forward contracts are often used for hedging against future risks in currency, interest rates, or commodity prices. For example, a farmer might use a forward contract to lock in the sales price of crops, ensuring they remain protected against market fluctuations. Swaps. Swaps are derivative contracts where two parties exchange financial instruments. The usual aim is to transform cash flows without altering the underlying holder's positions. Interest rate swaps. These swaps are the most common type. They involve exchanging a fixed interest rate for a floating rate or vice versa. For instance, companies may use them to hedge against interest rate risk. Currency swaps. These involve exchanging principal and interest payments in different currencies. They are often used by multinational corporations to manage exposure to exchange rate fluctuations. For example, a US-based company operating in Europe could use currency swaps to mitigate currency risk and stabilize cash flows. Options. OTC options provide the right, but not the obligation, to buy or sell an asset at an agreed price before a specified date. They differ from exchange-traded options in several ways. Customization. OTC options allow extensive customization. Participants can tailor terms regarding expiration, strike prices, and the underlying asset. It's like having a custom-made suit rather than an off-the-rack one. Differences from standard options. Unlike standardized options on exchanges, OTC options may cover a broader array of underlying assets, including those not typically available on traditional exchanges. As a result, they can be more precise tools for specific hedging or speculative strategies. These OTC derivatives provide essential tools for financial markets, enabling unprecedented flexibility. Whether it's hedging risks or speculating for gains, the ability to customize contracts places a powerful instrument in the hands of financial participants. Understanding these derivatives is like possessing a versatile toolkit, empowering you to craft the right strategy for any financial challenge. Benefits of OTC derivatives. OTC derivatives stand out in the financial market for several important reasons. They bring unique advantages that can shape how institutions and investors manage their financial strategies. Let's explore two of the main benefits: customization and liquidity. Customization and flexibility. One of the most significant benefits of OTC derivatives is their ability to be customized. Standard contracts often don't meet every need, which is where OTC products shine. With OTC derivatives, you can tailor the contract terms to fit your specific goals. Here's how. Unique terms. You can negotiate expiration dates, payment schedules, and underlying assets based on your requirements. For example, a company worried about future interest rate changes can create a swap that aligns perfectly with their cash flow needs. Personalized hedging strategies. Unlike standard contracts, OTC derivatives allow you to design a strategy that directly addresses your risks. It's like ordering a pizza with all your favorite toppings, instead of settling for a menu option. Better alignment with business objectives. Custom contracts can provide better alignment with overall business objectives. This means you can create instruments that specifically mitigate the risks your company faces. Customization leads to more effective hedging and investment strategies. You don't just fit into a mold, you create one that works for you. Liquidity and access to markets. OTC derivatives also offer increased liquidity and access to various markets. This can be a game changer for many participants. Here's why. Direct trading. OTC derivatives are traded directly between parties, often leading to quicker transactions. This creates a more liquid market, allowing for easier entry and exit. Wider range of instruments. Through OTC derivatives, traders can access a broader range of financial instruments. This opens doors to various opportunities, even in niche markets. Want to hedge against a specific currency fluctuation? OTC gives you the flexibility to do so. Reduced barriers to entry. For smaller firms or individual investors, OTC derivatives can provide access to markets that were once out of reach. You don't need to be a large institution to participate effectively. Market adaptability. OTC products can adapt quickly to changing market conditions. This keeps your options open, allowing for a more responsive trading strategy. In summary, OTC derivatives empower market participants by providing tailored solutions and enhancing access to varied financial markets. Understanding these benefits can lead to smarter investment and hedging choices. How could leveraging these advantages change your financial approach? Stay tuned to continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.